Greetings, friends. This is Oleh Ivchenko, head of the company Pareto. You're watching another episode of Pareto Point, dedicated to transfer pricing, CFCs, and international taxation. Our topics today are as follows. The State Tax Service of Ukraine has provided clarifications regarding the special regime's defense city and Diia City. The Organization for Economic Cooperation and Development is improving transfer pricing tools. Research on tax havens is becoming the foundation for modern transfer pricing. All of this will be covered in our episode. Let's get started. The State Tax Service of Ukraine has reminded everyone, the special regime's defense city and Diia City do not exempt companies from complying with transfer pricing rules. If a company conducts controlled transactions, it is required to apply the arm's length principle in accordance with Article 39 of the Tax Code of Ukraine. For Diia City residents, for the purposes of transfer pricing, any business transactions that may affect the pre-tax financial result are recognized as relevant operations. If such transactions meet the criteria for being controlled, it is necessary to submit a report on controlled transactions, a notification of participation in an international group of companies, and provide documentation justifying the arm's length nature of the terms. That is, even within special regimes, transfer pricing requirements remain in effect. On February 17, 2026, the Organization for Economic Cooperation and Development updated its guidance regarding Amount B, a simplified approach to transfer pricing for basic marketing and distribution functions within a group. That is, when a company sells or promotes products within a single international structure. This approach was introduced as part of the OECD and G20's global tax reform, known as Pillar 1, which aims to unify the rules for taxing transnational businesses. The OECD has published 9 new clarifications and updated the automatic calculation tool for 2026. The idea is simple: fewer complex calculations, more unified rules, and fewer disputes over compliance with the arm's length principle. In February, 32 years ago, American tax researcher James Hines Jr. published a scientific article that for the first time systematically explained the role of so-called tax havens, countries or jurisdictions with very low corporate income tax rates or special preferential regimes for foreign companies. In his work, he demonstrated that multinational corporations can shift profits to such jurisdictions through mechanisms of international tax planning. Later, these phenomena became collectively known as BEPS, base erosion and profit shifting, the erosion of the tax base and the shifting of profits. Heinz's research demonstrated that profit shifting can distort the economic statistics of countries and affect the global tax system. It became an important academic prerequisite for subsequent international discussions, which later led to the development of modern transfer pricing rules and initiatives to control controlled foreign companies. That brings us to the end of today's episode. I, Oleh Ivchenko, and the Pareto team thank you for your attention and trust. If you found this material useful, please support the episode with a like and share it with your colleagues. Subscribe to our newsletter on LinkedIn and read our analytics on the Pareto website blog. All the links, as always, are in the description. We look forward to seeing you in the next episode of Pareto Point. Thank you so much for joining us today, and we hope you have a great day. Until next time.